Thank you for tuning in once again. Friends, I'm your host, none other than Mr. Spotter Fred. I've come back to do what I like doing most. Now remember, we are still looking at financial reporting. And we are talking about institutional accounts or firms. This is what we have been dealing from the past sessions. Now remember, in the previous sessions, we talked about IS 41, farming activities. We talked about accounting for banks and other financial institutions. We talked about insurance, how to account for insurance companies. Then we talked about professional firms. Then we also have pension accounts, pension and employment benefits. So we have looked at these in the previous sessions, and what we have not looked at is the item E. So we want to look at pension accounts, pension accounts, which is actually IS 26. When you talk of pension accounts, you cannot forget to talk about employment benefits and employment benefits. However, we'll not go into details with employment benefits. Now, when you talk of employment benefits, friends, we talk of employment benefits. Employment benefits comprise of, these are the rewards that were given after an employee has worked. One of the employment benefits, one is the short-term employment benefits. Two, we have termination benefits. Three, we have post-employment benefits. Then four, we have other long-term benefits. These are the employment benefits under IS 19 when one has retired or when one is working in an organization, is entitled to short-term employment benefits, just like salaries and wages. Leave pay within, short-term employment benefits fall within the 12 months. While the termination benefits, when the employer has contradicted the contract, so he has terminated the contract, he'll have to pay you those benefits. The post-employment benefits is after retirement. After you have completed the age of the contract, the age of retirement, now you'll be given the post-employment benefits, which we may have defined or contribution or defined benefit. And we also have other long-term employee benefits. We may not want to go into details of the employment benefits, but there are those items that we'll mention when we talk of pension accounts. Now, mainly, when we talk of IS 26, in IS 26, we are looking at the reporting of pension. When we talk of the pension or plans or schemes, we are looking at an example of like NSSF. We look at some internal schemes or welfares. How do they report or prepare their financial statements? So we look at in IS 26, we are going to look at the scope. What the scope, the reporting scope of pension accounts. We'll also look at definitely the objective. The objective of that should be what should have started with. Then we'll look at some definition. Some definitions. Then we'll also look at financial statements. financial statements. Basically, the financial statements are two. These are statement of changes in equity, statement of changes in net assets and a statement of net assets. Then we also have the contents. Then we talk about disclosure requirements. That's what we want to talk about when it comes to IS 26. Now, we're saying that the scope of this standard shall be applied in the financial statements of retirement benefit plans where such financial statements are prepared. Retirement benefit plans are sometimes referred to as by various other names such as pension schemes, superannuation schemes, retirement benefit schemes, and the standard regards a retirement benefit plan as a reporting entity separate from the employers of the participants in the plan or other the financial to the extent that they are not superseded by the standard. Now, this standard deals with accounting and reporting by retirement benefit plans. The scope of this standard is that it shall be applied in the financial statements of retirement benefits plans where such financial statements are prepared. Retirement benefit plans are sometimes referred to by various other names such as pension schemes, superannuation schemes, or retirement benefit schemes. This standard regards a retirement benefit plan as a reporting entity separate from the employers of the participants in the plan. All other standards apply to the financial statements of retirement benefits plans to the extent that they are not superseded by this standard. This standard deals with accounting and reporting by the plan to all participants as a group. It does not deal with reports to individual participants about their retirement benefits rights. It should also be remembered that IS 19 employee benefits is concerned with the determination of the cost of the retirement benefit in the financial statements of employers having plans. Hence, this standard complements the IS 19. We have various definitions. The following terms are used in this standard with the meaning specified. 1. There is a retirement benefit plan. These are arrangements where an entity provides benefits for employees on or after termination of service, either in form of an annual income or as a lump sum, when such benefits or the contributions towards them can be determined or estimated in advance of retirement from the provisions of a document or from the entity's practices. Defined contribution plans are retirement benefit plans under which amounts to be paid as retirement benefits are determined by contributions to a fund together with investment earnings thereon. Defined benefit plan are retirement benefit plan under which amounts to be paid as retirement benefits are determined by reference to a formula usually based on employees' earnings or years of service. Next, funding is a transfer of assets to an entity separate from the employer's entity to meet future obligations for the payment of retirement benefits scheme. We also be using there is also the elements of participants who are the members. Net assets available for benefits are the assets of plan less liabilities other than the actuarial present value of promised retirement benefits. We have actuarial present value of promised retirement benefits is the present value of the expected payments. We have the vested benefits are benefits, the rights to which under the conditions of a retirement benefit plan are not conditional on continued employment. Some retirement benefit plans have sponsors other than employers. This standard also applies to the financial statements as such plans. We have some retirement benefit plans are normally described as either defined contribution plan or defined benefit plan, each having their own distinctive characteristics. Occasionally, plans exist that contain characteristics of both such hybrid plans and considered to be defined benefit plan for the purpose of this standard. The defined contribution plans, the financial statements of defined contribution plans shall contain a statement of net assets available for benefits and a description of the funding policy. Under a defined contribution plan, the amount of a participant's future benefits is determined by the contributions paid by the employer, the participant or both, and the operating efficiency and investment earnings of the fund, and employer obligations is usually discharged by contributions to the fund. And actuary advice is not normally required, although such advice is sometimes used to estimate future benefits. The objective of the reporting by defined contribution plan is periodically to provide information about the plan and the performance of its investment. That objective is usually achieved by providing financial statements including a description of significant activities, a statement of reporting on the transactions and investment performance, a description of the investment policies. While on the other hand, we have the defined benefit plan. The financial statements of a defined benefit plan shall contain either a statement that shows the net assets available for benefits, the actuarial present value or promised retirement benefits distinguishing between vested benefits and unvested benefits, and 3, the resulting excess or deficit. And B, the defined benefit plan shall also recognize the statement of net assets available for benefits including either a note disclosing the actuarial present or a reference to this information accompanying actuarial report. The financial statements that always from summary, at that point we have noticed that there is some financial statements that will be required to be prepared, mainly financial statements, the financial statements from the two, the financial statements for a defined contribution plan and a defined benefit plan are mainly